Hello, welcome to What's Up in Real Estate. My name is Brian Stuckey. We've got a program today. You might want to go get your pen and paper with you today. We're going to talk about renting versus buying. A lot of us out there are renting and we're throwing money out the window. We're going to find out today if it might be a good idea to be looking at some buying options in your real estate. I'm with Marianne Ross with Capital Management Group in San Jose. And Marianne, thanks for coming on the program.
You're welcome.
Let's get right to it. A lot of people are out there renting. They could be foolishly throwing money out, and they might not know it, but they could be buying. What's your feeling on that? Do you sit down with people from time to time and weigh those options?
We do that always. Most people don't realize, or I guess they do realize, that the rent they pay is money gone. The landlord gets it. They get no tax write-offs for the rent that they pay. But rents right now are at a premium, and so most people are paying almost as much, and in fact, with the tax savings factored in, more than it would cost to buy a home. I have a graph that has some assumptions. I've created a fictional taxpayer, a couple filing a joint return, no children, combined earnings of $100,000, a $207,000 mortgage, which I believe would buy them about a $230,000 house,
okay.
At 8% interest per year or interest per annum for 30 years. I've calculated that their rental payments or their mortgage payments would be $18,227 compared to $18,000 in rent. As a homeowner, though, you'd also have costs like taxes and insurance and PMI, which would bring the total cost of owning a home to $22,422, which is substantially more than the $18,000 you'd pay for rent. However, if you factor in the savings in federal taxes and California taxes, you could reduce that cost by about $5,950. That is your marginal rate of 34%. So the tax savings bring the net cost of owning a home to $16,472 as opposed to $18,000 for renting. So if you can come up with the down payment and if you can qualify for the loan, buying is the better option. You also have the investment potential when you own the home.
Okay. Investment potential, you mean from you can build up equity?
You build up equity, the home goes up in value, you can then sell your home and with that increase in equity, buy a more expensive home.
We want to talk about buying up at a later program. We've asked you to come back, and I wanted to ask you too, and MCCs, do they factor in here too? I noticed on your screen.
MCCs.
Mortgage certificates.
Oh, okay, okay. Do they factor in? You can get a credit on your tax return. Normally, the credit is worth about 20%.
Okay.
So if you were to, in this case that I illustrated earlier on, if you were to pay $18,000 in mortgage interest, a common way of treating that would be you would reduce your mortgage deduction by 20%, but you would get an actual credit on your tax return. So the mortgage certificates are really helpful for buying.
Great. We know that they come and go as far as the availability of mortgage credit certificates, but how do you look at points too? I know whenever people always think about interest rate and points when they get a loan, they know there's benefits of buying versus renting, but how do points factor in too? Is it a good idea to buy points, or I mean to pay more points?
To pay the points? Well, my feeling is that if you can get a loan without the points, your upfront costs are a little bit lower. Of course, your interest rate will usually be higher if you have a no-point loan. But if you do pay points, the points are deductible in the year paid. So in the first year, that's quite a bump in your interest deduction to pay the points.
Okay. We'll talk more about those in other programs with the benefits of paying points and how they work together. But Marianne, thanks for laying the groundwork for today's program.
Thank you.
You don't mind if people calling you, do you?
No, not at all.
Okay,
not
so Marianne's number appears. You know, you might want to give her a call. She'll also be available. If you want to get a hold of us, we'll make sure we know. We'll allow you to be contacted with Marianne down the road. When we come back, we're going to have some representatives from Chase Manhattan. Who's got a 2-3 program. You're going to love it. It's for first-time home buyers. So when we come back, we'll have them with us. We'll see you in a bit. Hello, welcome back to What's Up in Real Estate. I've got 3 representatives from Chase Manhattan, a prominent lender in the Valley. We have Liz Lehr, Elena Musselman, and Rouvan with us. And I'm going to start with you, Liz. First of all, Chase Manhattan's always been a very strong lender in the Valley. I want to ask you right off the bat, before we go into 2-3 program, Chase has always been considered an excellent jumbo lender. What interest do you have in this kind of program, which is, I don't know, you probably have some other programs quite like it, but this is a landmark type of program.
It's very strong interest. One thing that Chase has always had is a full array of programs that we offer to all types of borrowers so that we can fill all their lending needs, whether it's a jumbo borrower or somebody in the conforming market, first-time home buyer, or even an FHA or VA borrower.
Okay, so this is something. Have you had success? Have you been able to gauge and see what kind of success you've had on specifically the 2-3 program?
That's a new program for us.
Okay. That
is designed for the first-time home buyer, so haven't had a lot of history to be able to gauge that, but it's taking off very well.
But we're all going to be beneficiaries of it.
Yes,
So
absolutely.
Why don't we talk about initially, before we get specifically into the 2-3 program, what are some of the things that suggestions you would have for buyers when they're considering buying a first-time home?
First and foremost, I feel if they find a good mortgage broker, as yourself,
well, thank you.
You're welcome. They can help them in many aspects. They can pre-qualify them, make sure how much a house they can afford to buy. They can receive a pre-approved qualification letter from a lender, as ourselves, that they can take out when they're seeing their real estate agent and show that they've already been qualified for X amount of dollars.
Does that make a big difference?
You know, it does. I think most sellers and real estate agents feel more comfortable if a borrower does have a pre-qualification letter, because it shows that there's not going to be a hang-up when it's time to close that loan. This borrower is qualified for this property, and they're looking in the price range that they can afford to do. Okay. They can also help them obtain private mortgage insurance approval also prior to finding the home that they're looking for. Second thing, and again with the help of your mortgage broker, is to select a good real estate agent. And the third and last, and very importantly, is to attend a first-time home buyer education seminar.
Okay. I notice you have it on your graphics about the importance of a first-time home buyer education. What's the purpose of that, and why don't you go through some of the things that with regards to home buyers?
Certainly. We have some good bullet points on just the basics. But basically what it teaches someone to do is how to select a home that fits in their budget, that fits with their monthly payments, with their income, so that they're going out and knowing they have a comfort level that they can make their payment every month easily. Second, it helps them plan and save for the unexpected home repair. Mm-hmm. Teaches them the importance of obtaining a home inspection, particularly if you've got an older property, you know what you're in for. Also, it helps them understand the mortgage closing end. It's always the fear of the unknown is going in and signing all these loan documents, and it gives them a real comfort level when they go in of knowing what they are signing. Mm-hmm. Also, it'll teach them how to purchase a home quicker using simply 2% of their own money to get into that home of their dreams.
Okay. And it seems like an important step. I think a lot of time it's a big mystery when people go into home buying. It's a nerve-wracking type of situation. So do you find a lot of people when they get through this that they feel like they have a pretty good idea of what to expect?
You know, I think so, because knowledge is power, and the fear of the unknown is always great when you venture into something new, and home buying is a very stressful time. So this gives them a real comfort level of what to expect all the way from the beginning through the closing of their loan.
Great, Liz. And you teach all these classes, right?
Of course.
Yeah. Elaine, I want to talk to you now about specifically the 2-3 program. Let's talk about the 2% down payment that people can come in with. Usually you're thinking 20%, 10%, or whatever, but this is a little different. Why don't you give us an idea about this program?
This 2% down, excuse me, this 2% down payment program is called the Chase Risk Share Program. Okay. And basically it is a portfolio program that Chase has to offer. We're the only lender in the Valley that has this program. And basically a client on a fixed rate program for 30 years, 25 years, or 20 years can bring in 2% of their own money and then find the other 3% to do a 95% loan to value. So on a for example, of a sales price of $218,000 and doing a loan amount of $207,000, the borrower would only have to come up with $6,000. Mm-hmm. And they would be able to buy their first home. Okay. They do have to be a first-time home buyer, which would mean that they cannot have owned any other property within the most recent 12-month period. And with this program, though, one of the requirements is that they go through the home buyer course. It is a requirement. Liz talked about the benefits of the first-time home buyer class. Not only is it important for all those reasons, but it's a requirement. We are doing a joint venture with PMI Mortgage Insurance Company, and that's why we're able to offer this program where our clients only have 2% of their own money.
Okay. Now, we had talked a little bit before, too. The graphics might have been a little difficult for people to read. SFR, single-family residence, and there's some other ones in there. But can you combine this also with the MCC?
This program, Chase does allow a client to do the MCC program in Santa Clara County, the mortgage credit certificate. Yes, you can do that with this program.
Can you explain a little bit what PMI is? People throw out this term, and I think it's important for people to know exactly what that is.
PMI stands for Private Mortgage Insurance, and private mortgage insurance is something that you as a buyer would pay for, and it protects the lender. And it protects the lender because you have what a lender sees as a risky transaction, because a client only has 2% of their own money into the deal. And in order to do that type of a risky transaction, you pay for mortgage insurance, which on a purchase price of $218,000 would probably cost a client about $150 a month. That $150 a month protects the lender if a buyer were to be in a position where they couldn't make their mortgage payments anymore.
Okay. People don't jump up and down when they hear that they got to pay that.
I know.
But let's be on the positive side. Is that PMI always going to stick with them?
That's a good point. Once you achieve a certain equity position in your property, you can remove the mortgage insurance. There are certain steps that a borrower has to go through, but you can remove the mortgage insurance.
So, for example, the value of the property goes up.
The general rule is 80%, so you would have to have an equity position of 20%, and you'd be able to remove the mortgage insurance.
Great. That is good news.
That's the good part. That's the good news. But then also, I mean, you take that one step further, you're able to buy a house for $6,000.
Okay. Well, that's the whole point of this one, is that it's exciting to know that you can actually get into a house with $6,000. Rouvan, why don't you talk about the other cash part? We've talked about the 2% down. What's the 3% represent in the cash program?
Well, in this particular case, the 3% is essentially an unsecured line of credit with a maximum of $5,000. Chase, the cash program stands for Chase Assisted Settlement for Home Buyers. And what it is this unsecured line of $5,000 that is tied into the 2%. So the borrower is required to come up with 2% down, and then we'll loan them an additional 3% along with the first mortgage. So that's a beautiful point of the programs. If you bring up the graphic, some of the benefits of the cash program is the funds can be used to cover the down payment, prepayment costs, the closing costs, in conjunction with the Chase first mortgage. Also, up to $5,000 may be available for qualified applicants, as I said before. The cash loan is amortized over 3 to 5 years, and the borrower makes only one payment to Chase. And the interest is the same as the cash loan as well as the first mortgage. So you get the same interest rate, which is a discount these days for unsecured lines.
And for a lot of people, they probably have a hard time just believing exactly what they said again. So I want to repeat it again a little bit and kind of reiterate what we just talked about. The 3% can represent part of the down payment.
Yes, it can.
As well as it can cover closing costs.
As well.
Okay.
Too. Yeah.
And it doesn't represent a second mortgage?
No, it's an unsecured line. And what that means is that's not tied to any collateral. And in this case, it's not tied to the house.
Okay. And the interest rate will be in one payment.
Right. One payment and the same as the first mortgage. So if you have an 8 1/4 first mortgage, you have an 8 1/4 unsecured line for $5,000.
Okay. And again, for how long?
For 3 to 5 years.
Okay.
Amortization means payment stretched over that period of time. 3 to 5 years.
Good. What kind of target groups are you looking for, Chase Manhattan? What again, we talked about jumbo lending before, but specifically with this program, it seems like it opens up the door for a lot of people that haven't been able to get in before.
Well, the program is for everybody, for sure, but there are general groups sometimes that have problems coming up with money in to buy a house. So this opens it up to a new market, some Hispanics, African Americans, sometimes people who traditionally have that problem of coming up with funds to move into a house so everybody can move into the American dream. But that doesn't exclude anybody else as well.
How about loan officers? Would we be able to get in the door there?
Never owned a home before, you certainly
If we ever
could.
Sure. Is there any restrictions on the type of homes that you can get into?
On this program, we do single-family residences, SFRs. That
That's
was
what
on
your
your
graphics are,
right.
yeah. Single-family
Residences, condominiums, and PUDs. PUD stands for Planned Unit Development, and there's a good combination of all those properties right here in Santa Clara County.
Okay. This is an outstanding program that we're excited about being a participant with you in. We hope that we go out there and sell this product for you. Chase Manhattan's also got some other products. Why don't we go ahead and give you guys a plug at this point? Is there any other programs that you think would be good ones to plug for your company?
I think that Chase Manhattan offers a full range of products for borrowers. First-time home buyers, we have 3 very, very good first-time home buyer programs. And then we have jumbo loans, fixed rate and adjustable rate programs, loans that require mortgage insurance, and self-insuring loans as well, where you're talking about the borrower would not have to pay the mortgage insurance cost. That cost would all be built right into the interest rate, and we talked earlier in the first segment the tax benefits of that. So I really feel that Chase offers both the well-heeled borrower and the first-time home buyer financing options.
Okay. I want to welcome you guys for coming. Liz, thank you. You did well. And Elena and Rouvan. When we come back, Greg Flowers is going to be with us along with Dan Lawson. We're going to talk about, well, whatever Greg talks about, which is something to do with economics. So we'll be right back in just a moment.
Welcome back.